Right now, you are taking the full risk of the stock market for almost none of the extra reward. Normally, stocks are priced to pay you more than a safe government bond. That gap is your reward for taking the risk. For decades, stocks were priced to return about 3% to 5% a year on top of what bonds paid. Today, that reward has nearly vanished. A 10-year US Treasury now pays about 4.5% risk-free. Based on its earnings, the S&P 500 yields only about 4.6%. That leaves a premium of well under 0.5% for taking on all the risk of stocks, the smallest since 1999. For years, the logic was simple. There was no alternative to stocks because cash and bonds paid almost nothing. At 4.5% with no risk, that's no longer true. This comes down to valuation, how much you pay for each dollar a company earns. The most reliable gauge, the Shiller PE, averages earnings over 10 years, and the higher it climbs, the weaker the returns that have historically followed. Right now, it sits near 40, a level reached only once before, at the peak of the dot-com bubble in 1999. The market's never been more expensive. The most famous long-term investor in the world is stepping back. Warren Buffett's Berkshire Hathaway holds a record $397 billion in cash, parked in Treasury bills. He's been a net seller of stocks for 3 years. Put it together, and the trade is lopsided. While none of this means a crash is coming, it does mean you'd be carrying the entire downside risk of stocks at the highest valuation in a generation, only to beat cash by a rounding error.